Hello and welcome to week 11 of PUBH 610. Today we will discuss the role of budgets in public health programs and organizations in general. The learning objectives for this week are to understand basic accounting and finance terms, to know how to read financial statements and understand how financial transactions are recorded, to appreciate the importance of budgets and how to create them, and also to recognize that budgets can be planning and evaluation tools, and lastly, to know the four components of a complete budget package. Accounting affects all organizations, and public health organizations are included. While you don't need to be an accountant to be a public health leader or manager, you should be familiar with these accounting concepts. Assets are an economic resource. Liabilities are debts owed by an organization. Examples of liabilities are loans payable, taxes payable, etc. Bills or other debts owed to others by an agency are frequently called payables, while examples of assets are machinery, equipment, inventory, investments, cash, and accounts receivable, and hence money or other income owed to an organization or agency are frequently called receivables. Equity capital is also known as capital, net worth, or net assets, and is the value of an organization or business at historical or original cost after liabilities have been deducted from the assets. Revenue encompasses the earnings of an agency. These can be from sales or, more often in public health, from providing services to people or patients. Expenses are outflows of assets, typically cash, and profit, also known as net income or excess of revenues over expenses in nonprofit, is the excess of revenues after expenses. Financial statements can be prepared at any time. The period is usually a year, and the period does not need to necessarily end on December 31st. Different organizations in the government, for instance, have different fiscal calendars. The lowest inventory level, the end of the busy period, or the end of funding, are common ending times. Here are four basic components of a financial statement. You'll need a balance sheet, which summarizes the financial position at any given point in time, an income statement, which delineates profits or loss, statements of changes in net assets, which provides reasons for fluctuations in net assets, and a statement of cash flow, which provides information regarding cash received and cash paid out. One reason for collecting and processing accounting data is to provide management with information to make informed decisions. In addition to financial statements, management reports are prepared and used by managers at various levels to maintain and improve fiscal control and profitability of an organization. Reports include budget, cash flow projections, profitability by product line, and ration analysis. And cash flow reporting estimates the cash payments and receipts. A quick summary of accounting is that it's linked with daily professional activities, and public health professionals should really understand the rationale and logic of accounting records and procedures. And all managers must know the basics of accounting in order to survive. Financial information addresses the fiscal status of an organization and contributes to the process of determining the fiscal status of an organization or evaluating a planned investment. Money is rarely unlimited, and therefore it has a cost, and an evaluation of a proposed project should take into account all the costs and other problems related to acquiring funds. These factors should be balanced against the expected profits or benefits. But there's a degree of uncertainty around how much money you expect to make, and therefore most projects involve some degree of risk. In summary of finance, financial data determines the fiscal health of an organization, and finances must be considered whenever decisions that can affect an agency are made. And compensation for assuming risks must be included in making financial decisions. Budget preparation and oversight are considered managerial duties. So managers should expect to prepare budgets. In order to create a budget, managers must examine and understand information about historical costs, and they must understand sources of revenue and be able to fund organizational programs and services in a way which enable the program to achieve its goals. Managers who fully understand budgets will have a very powerful planning tool at their disposal. A budget is a plan for the use of funds. It's not a bank account from which you can just draw money. Budgets provide a plan for the use of funds to meet organizational objectives and goals, and when assembling a budget, information should flow from the lower levels to the higher ones. Regarding making informed budgeting decisions, it's important to remember that a budget is a working document. And typically budgets from previous years are examined, and you'll designate available funds. Operating plans can become reality as a budget is spent. And you should typically begin budget preparations early. And category by category, you'll compare the actual spending with what you've put in your budget. And lastly, remember that your evaluations and using budgeting your budgets as a tool for evaluations will only be useful if you have accurate information. A complete budget should have these 4 components. A statistics budget includes items that can be accurately predicted. For example, service utilization by type of service and payer mix. Expense budget is a prediction of total expenses, while a revenue budget is a prediction of how much revenue or credit accounting entries will be recorded during the budget period. And lastly, a cash budget summarizes the amount and timing of anticipated cash into and out of an agency. Budget allocations are compared with the actual expenditures, as I previously said, and this will help to determine if categories are overfunded or underfunded. The aspects listed here should be addressed in a budget, such as a justification of different expenses and detailed information about expected costs. And to be clear, you don't need to justify every single line item. If the budget line item is less than, I think, $200, it doesn't require a justification, but be sure to check in with your funder to see explicitly what they want. Incremental budgeting uses the previous fiscal operating plan, expense budget, and revenue budget to guide and justify those items for the next fiscal period. Public health departments use incremental budgeting, while a zero-based budget requires a complete item-by-item annual review of the operating plan. Each activity and expenditure must be justified and then prioritized. The bottom-up budgeting process begins with information provided by the lowest level personnel. Information from program or service employees who interact with the public are important to make sure that a budget is an effective planning tool. Lower levels comprise most budgets, however, senior managers must enforce cost controls in order to stay within an agency's financial constraints, and top-down budgets are controlled by management. A mix of the two types is optimal, and budget meetings which provide feedback are encouraged. Fixed budgeting assigns specific dollar amounts to every line item, while flexible budgeting, as the name implies, enables costs to be adjusted as the service load varies. It's appropriate to have a mix of both in your budget. Your revenue increases as your service volume increases, and a unit with fixed revenue budget can't increase its level of service unless flexible budget revenues are available. A flexible budget is not going to be able to be justifiable. In summary, accounting and budgeting, these are important planning and managerial skills in any organization, and that includes public health. Managers must understand these basic concepts and principles in order to do their job and do it well. And you shouldn't forget that evaluating programs is linked to accounting. Please check out Blackboard for any additional materials for this week. That's going to be it.